This is Taking Stock on Bloomberg. I'm Pimm Fox. Networking products maker Cisco reporting earnings after the bell this afternoon. Edward Jones analyst Bill Kreher has been listening to Cisco's conference call, and he's on the telephone now to help us break down the results. All right, explain a little bit about what you're hearing from Cisco. They exceeded analyst average expectations for earnings. What are they telling you in terms of guidance for the future?
Sure, and thanks for having me on. I think that the earnings results themselves were actually quite positive. The company had a pretty low bar to jump over, which they successfully navigated. However, the outlook is a bit disappointing. I think that the street will likely view it with disappointment, given that not only the fourth quarter is going to be a little bit weak, but John Chambers admitted that the long-term revenue growth forecast of 12 to 17% is probably not likely to be achieved in fiscal 2012, and it appears that this turnaround may take a little bit longer than previously expected.
What are the challenges? Is it competition, or is it customers are not spending money?
Well, I think some of the stuff is unique to Cisco. There is some competition, certainly in their core business of routers and switches. Juniper and Hewlett-Packard continue to make life a little bit difficult for them, and that's been also exacerbated by a product transition that they're currently going through. In terms of structural issues, they still have a good deal of business in the public sector, those large government accounts like in U.S., Western Europe, and Japan. Those continue to be weak, and we think that'll negatively impact them throughout the year.
What about their operating margins, Bill?
Operating margins look pretty good. They essentially are saying that if they're not going to be getting the revenue they previously thought, then they're going to cut the fat in order to maintain that margin profile, which I think is very positive. A couple of things that the company did do that aren't going to show up necessarily for a quarter or so, but over time will help, is the fact that they do plan to streamline their operations. They're exiting non-core consumer businesses, and also from a capital deployment standpoint, they initiated their first dividend in their corporate history. We felt that was a necessary and favorable development.
All right, we've got to leave it there, but I want to thank you very much, Bill Kreher, joining us from Edward Jones, giving us some thoughts on the Cisco.